Just a bit.
Oh, there we go. Okay, can you hear me now? Okay. So, okay, Morgan, can you hear me all right? I just want to, yes, better. Okay, a little better. Okay, good. All right, thanks for inviting me out here today, Morgan. I appreciate that. And Doc will be following me with some really good information as well. So I urge everyone to stick around, and Doc will tell you how you can get more of our videos that we do every single day. So basically what I'm going to talk to you tonight about is what I like to call the powerful price patterns. I've got 3 price patterns that I use on a daily basis for not only day trading the E-mini futures market, but quite frankly, I use these 3 patterns when swing trading stocks, ETFs, Forex. I mean, I trade everything with these 3 price patterns. Basis of a lot of my trading, I mean, and I would say it's probably a 20th of what I look for, but I think these patterns will help you in your own trading. So let's just get started and go as quick as I can so I can get Doc on here. So obviously you need to understand, you know, the waves of the market, and you all are familiar with what an uptrend looks like, right? Basically higher highs, higher lows, right? And in a downtrend, you've got lower highs, lower lows. Pretty simple, straightforward, and elementary, right? But you need to first understand that. And obviously a sideways market where you've got relatively equal highs and equal lows. So a market can only do one of these 3 things at any one time, so you need to understand that. And to make it really objective, I'm going to show you just 2 moving averages, pretty basic, right? I use a 50 exponential moving average and an 89 exponential moving average to make it real objective. Let's take out the subjectivity and just take a look at these moving averages to define what the trend is. And then we're going to use the patterns I'm going to show you, and I'm going to, you know, give you specific trade setups that I personally look for on a daily basis. Okay, so we're going to make it real simple. Yeah, pretty basic here. So let's just go right into these moving averages. So let's talk about these 3 price patterns in an established uptrend first. Okay, the first one over here, all right, is what I call an outside vertical bar, a bullish outside vertical bar, right? The market must close in the top quarter of the range, right? And basically the market needs to penetrate through the prior bar's high and the prior bar's low, but it must close in that top quarter and exceed the range of the prior day completely. So for those of you that you know, prefer to use candlestick charts, I've also got a candlestick chart here, right? It's called a bullish engulfing pattern. I don't necessarily need to see the body take out the prior bar's high or low. I just need to see the wick. I mean, the highest high of the day and the lowest low of the day must penetrate through the high and the low of the prior day. In my eyes, that's, you know, that's an engulfing pattern, but it needs to close in that top quarter. So that's the first pattern. Then I'm going to show you some charts, okay, on all these patterns and how to apply it. The second pattern is what I like to call a blow-off bar. I call it a blow-off bar, but you know, just shorten it up with a bob, right? A lot of candlestick users like to call it the bullish hammer, right? This is where the open and close are in the top quarter of the bar's range, okay? So that's key. There's 2 key things here. The open and close are in the top quarter, and the range of the bar itself must be about 125% larger than the prior 3 to 5 bars. So you must have a larger range than what you've currently seen. So that's what I like to look for. And then the third pattern right here is the opposite of an outside bar or an engulfing pattern. It is the inside pattern, right? So typically the market's contracting when this happens, of course, right? The high is lower than the prior bar's high, and the low is higher than the prior bar's low. I love these little patterns, and if you've seen any of my daily videos that I do, you see me talk about this all the time, and I give out a bunch of trades as well. I scan the market nightly for these patterns and look for these patterns and narrow them down. So these are the 3 basic patterns, and again, we've got to be in an established uptrend, and the market needs to pull down into a logical support level. So again, to define that trend and make it as objective as possible, let's take out that subjectivity for the purpose of tonight's little presentation here. We're going to use a 50 exponential and an 89 exponential moving average. Now I get asked this question all the time, well, why do you use an exponential? Why not a simple or a weighted? I mean, look, at anything you use, whether it be weighted or simple or exponential, I don't really think any of the type of moving average you're going to use is necessarily better than the other. You just have to be consistent in the way you use what you decide to use, right? So if you decide to use a simple or an exponential, it doesn't matter. It's just you need to use it and be consistent with it, don't flip-flop. So I prefer the exponential because it weighs the most recent price action more heavily than the older data. So that's why I personally prefer that. So those are bullish, and these are the bearish for a downtrend. So what I just talked about, right, that's when the trend is up, making higher highs and higher lows, right? You're trading above both the 50 and the 89 exponential moving average. Now we're going to just flip this for a downtrend, market making lower lows and lower highs, right? So you flip it. So an engulfing pattern in this case is going to be bearish. It has to close in that bottom quarter, and the market must penetrate through the prior bar's high and low. It must exceed the high and the low and close in the bottom quarter. It's that simple. Again, the second pattern is that bar, but it's bearish. The open and close must be in that bottom quarter, or it doesn't fit within my criteria, right? Close and open in the bottom quarter. I mean, think about it. The market opens up, the market rallies intraday, and is able to somehow completely reverse again and trade lower and actually close near that open in the bottom quarter. That's, you know, that's a big event. If the market pulls back to logical areas, right? And in this example, right, the trend is down, the market's pulled up to a logical resistance area. Now, you might ask, well, do you only use these patterns in defined trends, up and down? Honestly, not necessarily. I use these patterns as well when the market is testing what I believe is a significant higher low. If the market's testing a prior higher low and I see one of these patterns, I'll look to take a trade, you know, counter trend, looking to try to pick that top or bottom, right? I'm anticipating a potential double or triple top or bottom. But in this presentation, I'm only going to show examples with trading with the trend with these two averages, 50 and 89. And again, that third pattern is that inside pattern. It's the opposite of an outside pattern, right? The outside pattern, you typically get a larger range bar, right? Because you got to take out the high and the low of the prior bar. Whereas that inside pattern, the market's contracting, right? The high is lower than the prior bar's high, and the low is higher than the prior bar's low. Okay, and I'm going to show you exactly. I'm going to give you entries and logical profit objectives on these. So, but I just wanted to first start off with showing you the three patterns, right? Three bullish price patterns in an established uptrend when the market pulls down in support, and three bearish price patterns when the market's in a downtrend and the market's able to rally up into resistance. Okay. So let's go into the first one, right? The bullish outside bar, or the bullish engulfing pattern. Okay, a little bit more detail here. We've already talked about bullet point number one. Market must exceed through the prior bar's high and low, right? And again, we're only really looking for these patterns in logical support in an established uptrend, right? So the market's already up, market's pulled back. So what we're looking for is for the market to take out the prior bar's high and low, right? You see that? So your buy entry is either the close of the open the following day, once you see it close in the top quarter, right? If you want to be a little more conservative, wait for the market to actually penetrate up through the high of that outside pattern. Again, you'll notice that on all these illustrations, I've got two illustrations, right? Number one over here in a regular bar chart, and then over here is a candlestick chart. So it's really the same thing. I started trading back in 86, 87 with the use of bar charts. Never used the candlestick chart, but I know most people these days prefer to use candlesticks, so I use those in my presentations as well, and I do use them as well. Not all the time, but again, it's going to give you the same end result anyways. So you're looking to, this is the trade. So you're either buying it on the close of the open the following day, or as the market penetrates through the high of the bullish outside vertical bar. Your initial stop loss, the ISL, is immediately placed below the low of that bullish bar, right? Your first profit objective is the actual range of that outside pattern. So take the high minus the low of the day, get the range, and add that range up to up from your entry. You're going to add it to your entry, and that is your profit objective, which is represented here in the green horizontal. Okay? Over here, exact same thing. So that is the first pattern and how you use it. Let's take a look at a chart. The random chart here, the market is trading, making higher highs as the market is trading above both the 50 and 89 exponential moving average. Again, we're going to try to make it as objective as possible. You're trading above those two moving averages, right, with a series of higher highs like you see here, higher highs, and you're trading above those averages. Once that market pulls down from that high, you're looking for a price pattern, right? So the first one we talked about is that bullish outside vertical bar. And you pull back into these averages, went a little bit lower, but then saw an outside vertical bar closing in the top quarter of that range is very powerful. That is a signal where your initial stop loss would be placed below the low, and your profit objective would be at least the range of that outside bar. So you can take the high minus the low and add it to your entry. So if you entered on the close, great, you made money on the open because it gapped. If you didn't, like in a case like this, if you were waiting for the next day to open and take out that high, I would have missed this trade altogether because I don't trade when it gaps through my entry price. Then I either wait for the market to pull back where I would have entered anyways, or if it doesn't, I miss the trade altogether. So by entering on the close of this particular trade, you would have made money, right, on the open, and it would have hit your profit objective right in here. Okay, so let's just flip this example. Okay, so I'm going to show you the bear trap. Okay, this is another. It's the same pattern. It's an outside pattern, but the reason I'm going to include this pattern with the bullish outside is because it's happening at the same place on a chart, right? So the trend is up, right? The established trend is up. The market pulls back into a logical support level. So instead of getting a bullish engulfing pattern, you actually get a bearish engulfing pattern, as you'll see here. The market closes in the bottom quarter. But this is a great trade because it doesn't happen very often. When it does, it's like taking candy from a baby. It's a very powerful move. Again, the trend is up. The market pulls down off of a high into a logical support level here. But again, instead of getting that bullish engulfing pattern, you get a bearish engulfing pattern, right? So if you get that bearish engulfing pattern, what I'm looking to do in the next 2 days, or the next 2 bars, regardless, I mean, depending on if you're day trading or using daily charts or a bigger time frame, I'm looking to buy that market automatically as it penetrates up through the high of the bearish engulfing pattern. So right in here would be my buy. Now, you might be saying, well, what about that inside? Well, you got an inside pattern here. I'd be buying through that high, but we're talking about the bear trap. I call it the bear trap, okay? So again, it's occurring at a logical support level in an established uptrend where I would normally be looking for, a bullish outside vertical bar, a bullish engulfing pattern, but instead of getting a bullish pattern, it's actually bearish. So, but if the market is able to reverse and trade up through the high, that bearish engulfing pattern, this is my entry right here. That is a great trade. So that's a little, again, it's the same premise of the outside vertical bar, the engulfing pattern. It's just the opposite. You're still looking to go long if the market takes out that high. The only difference here is it's not bullish, it's an actual bearish engulfing pattern. But again, if the market does not move lower and it trades up through the high of that bearish engulfing pattern within 2 price bars, that is an automatic buy. So I wanted to add that. And again, when you go long above that high, your ISL, your initial stop loss, goes directly below the low of the bearish engulfing pattern, okay? And your profit objective, right, is the same what I just showed you in the last slide, and that is the range of the bearish engulfing pattern. Take that range and add it to your entry, and that is your logical profit objective. Okay. So now, so let me give you an example. So again, you're trading above both averages, right? It's objective, right? No subjectivity here in terms of determining trend. I wanted to make it easy. You got the 50 exponential here. You got the 89 here. The market's trading above those averages with higher highs. You hit this high, you start to come down. Actually, I don't have this marked off. You got an inside bar. Now, I know I'm jumping ahead of myself just a little bit, but I've already talked about that inside vertical bar very briefly. You had one here. If you touch that upper moving average, you created that inside pattern. As soon as the market penetrated up through the high of that inside bar, your long is right here. You would have made money there. And you'll see in the next few slides here when I talk about that inside pattern that all your profit objectives would have been hit here before the market coming down here and actually creating this bearish engulfing pattern, right? You have a bearish engulfing pattern, right? Took out the high of the prior bar, took out the low of the prior bar, closing the bottom quarter. It's in a logical support level, right? Back between the 50 and 89 in an overall established uptrend, right? So again, within 2 price bars, if the market's able to take out the high of the bearish engulfing pattern, which it does, takes it out on the very next bar, that is your buy right there. Okay, so you're long there. Next day actually becomes an inside pattern, right? The high is lower than the prior bar's high. The low is higher than the prior bar's low. Again, and that's one of my patterns as well. So as soon as the market penetrates up through that high, it confirms that the market should in fact move higher. Not only because the market did in fact take out the high of the bearish engulfing pattern, but you had an inside vertical bar. So you actually had 2 patterns combined side by side. And as you can see in this move here, the market made a pretty dramatic move once it took out the high of that inside pattern. So another good example here. As you can see, even without waiting for any of those patterns that I'm talking about in the presentation, you had nice buying opportunities each time the market came down to those levels, even without waiting for them. So these are good patterns. They stack the probabilities in your favor. They don't happen a whole lot, but when they do, they are very powerful. Again, if you run a scan, you're going to find a bunch of these, and then you can read them out and try to filter out trades as well. So let's talk about, we talked about the bullish engulfing pattern. Let's just quickly reverse it for a down market. So the market's in a downtrend. The market pulls up into a logical resistance level. That's what we're waiting for here. So again, the overall trend is down, making lower lows, lower highs. Market finally hits the low, bounces up off that low, and creates a bearish engulfing pattern. Right? Again, market takes out the high of the prior bar and the low, and it closes in the bottom quarter. See that? It closes in the bottom quarter. So again, you either go short near the close or wait for the next day's open. It's really up to you. You can even wait for the next day to open. Maybe the market rallies a little bit. You could sell it there. Regardless of what you decide to do, your initial stop loss, ISL, needs to be placed directly above the high of the bearish engulfing pattern. Okay? Your profit objective, again, is 1 times the range of that engulfing pattern. Again, take high minus the low. That's your range. Take that range, subtract it down from your entry, and that is your objective. That is your first objective. Okay? So again, over here, this is a candlestick chart, just showing you the exact same thing I just showed you on a regular bar, right in here. Make sense? Go right back. But again, remember, got to be an established downtrend, right? I.e., the market's got to be trading below both the 79 exponential and the 50 exponential, and the market must pull up into a logical resistance area. That simple. Let's look at an example there. So again, market's trading below both of these moving averages, right? Moves down in here. You can see rallies up. First time you actually get one of these patterns right here, first circle here. Market takes out the high and the low of the prior bar, right? Closes in the bottom quarter, opens up next day. And as you can see, market makes a nice move to the downside. Your initial stop loss, your ISL, needs to be placed immediately above the high. And your first profit target, right? First profit target is the range of the bar itself, that bearish engulfing pattern, right? And take that range and subtract it down from your entry, and that gives you your first objective, right? There's a million ways to trail up a stop as well, and there could be a second profit objective. Let's say 1.5 times that range you could use as well. But a good starting point, first profit target should be the range of that engulfing pattern, right? And if the market hits, I would say 70% of your profit objective, I would move your stops to break even. Okay? Again, market makes a new low here, right? Takes out this low, rallies up, catch right in between the 50 and 89 exponential right in here. This is a resistance area, right? Looking for a price pattern. You see this? You see that bearish outside, closes in the bottom quarter, takes out the high and the low of the prior bar, closes in the bottom quarter. That is a short. That is a short trade. Place your initial stop loss above that high. And as you can see, market does exactly what you thought. So again, the reason I'm using that 1589 exponential is just to make things more objective. Make it real simple. You can use any moving average you want, but in this case, I wanted to use two longer moving averages. And so it works really well. Let's take a look at the bull trap, right? Okay, so again, we just talked about the bearish engulfing pattern. Now, what if, now remember, the trend is down, right? Making lower lows, lower highs. The market's trading below the 79 exponential and the 50 exponential, right? So it's objective. We know what the trend is. The trend is down. Market hits a low, bounces up to a logical resistance area, right? We're looking for the market to come into resistance. We would normally be expecting a bearish engulfing pattern or an inside or the bob, right? But again, we're talking about the bull trap, which is simply an engulfing pattern, but instead of being bearish, it's bullish because it closes in the top quarter. It's that simple. So, okay, so it's in resistance, right? It's in resistance. The trend is down. The market takes out the high and the low of the prior bar. Okay, it's a bullish bar, but again, this is a fantastic pattern. If the market happens to reverse and it actually takes out the low of the bullish engulfing pattern within 2 price bars, boom, right in here where I'm circling, that is an automatic entry. You're short right here, and you immediately place your ISL, your initial stop loss, above the high of the bullish engulfing pattern, which I like to call the bull trap. Okay? So that's a great trade. Again, your profit objective, just like if you're going long or going short on a regular engulfing pattern, right, is the range of the engulfing pattern. So take the high minus the low, get that range, subtract it down from your entry. Okay? It's that simple. Let's take a look at an example here. Again, the trend is down, right? The market's trading below the 79 to 50 exponential. Market pulls up, goes a little higher than normal. Again, if you're into Fibonacci retracements at all, I'm a big Fib fan. Market comes up, trades down here. You get a, look at this pattern. You get an engulfing pattern. Once it actually takes out the low of that engulfing pattern, you want to get short. Even though this isn't a clean move, I mean, it does rally up. The price does rally up through the upper moving average, but not enough for me to say that the trend is up now. Not at all, because you're not making higher highs. I mean, you take out the moving average, you make another higher high, but you don't have a flow, a wave. I'm looking for that wave above the upper moving average or the wave below, right? You don't get that, so you come down off that high and create, a bullish. Actually, this bar, I'm right here, paint number 1. That's actually a bullish engulfing pattern, right? So the bull trap, boom, right here is it takes out the low. This is where I'm looking to go short right in here. All right, so not a clean move, but still a move that makes sense according to exactly what I just showed you. All right, let's talk about the inside pattern. And if any of you have watched any of my daily videos, you've seen me talk about that inside bar quite a bit. So again, an inside bar is the opposite of an engulfing pattern, right? The engulfing pattern, you need to see the market take out the high and the low of the prior bar. The inside pattern is just the opposite, right? The market's contracting. The high is lower than the prior bar's high, and the low is higher than the prior bar's low. I love these patterns because when the market contracts, it must expand, right? It must expand. So I love when the market makes a clean move down off of a high and an established uptrend into a logical support level, and then creates this inside pattern, right? Because I don't care where the market closes, okay? I don't care where it closes. I don't care where it opens either. All I care about is if this pattern is inside of the prior bar, okay? So what I'm doing here, my entry, my trigger is to go long automatically as the market penetrates up through the high of that inside bar. Okay, this is my buy point as it penetrates up through it, okay? My ISL, my initial stop loss, is directly below the low of the prior bar. Give it a little bit of room below the prior bar's low. And my first profit target is 2 times the range of that inside pattern, right? So again, take the high minus the low of that little tight inside pattern, times 2, get that, and add it up to your entry price, and that gives you your first profit target, okay? And again, if you come over here, if you prefer to use candlesticks, that's fine. It's the same thing. Your entry is when the market, your actual trigger is when the market penetrates up to the high of that inside pattern. As soon as you get filled, you put your ISL, your initial stop loss, below the prior bar's low, and your first profit target is 2 times that range, right? It's as simple as that. Again, my rule of thumb is if the market's able to get to at least 70% of your first profit target, you should move your stops to break even, so you risk nothing on the trade. I typically do that in everything. You know, the way I trade is, you know, you've got to be defensive. Once you enter the market, you've got to be looking to move that initial stop loss as quickly as possible when things make sense. So it makes sense once the market hits 70%, I move it, okay? So trade management is very, very important, okay? And again, when you enter the market, you absolutely, unequivocally need that catastrophic stop loss. And this is where I place my stop here. Let's take a look at an example here. So the trend is up, obviously, as you can see. Price is clearly above both the 79 exponential and 50 exponential moving average. It's a high right in here, pulls down, touches that upper moving average, right? Got an inside bar right in here, as you can see. Takes it out. That's my buy trigger to go long. My initial stop loss would have been placed right in there. And if you take 2 times the range of that inside vertical bar, your first profit target will sit right in here with no problem. Market comes down a little bit further. I'm going to show you a loss here, right? Comes down. Remember, this is not as clean of a move as this first one, right? Got a nice big up move, and then a clean, crisp move to the downside. First pullback, once you hit this high, clean pullback down into the moving average, inside vertical bar, popped up through it. Nice trade right here. Again, I'm showing you a loss here, the second one, but I'll tell you, it's because, I mean, it wasn't as clean because look at, the market was not able to take out this high, right? It kind of failed in here. If the market had penetrated through this original high, then this would be a trade I'd be all over. But I wanted to point this out. It would have lost if you had taken this trade. But again, back to what I showed you on the very first slide. The market's got to be making higher highs and higher lows above both these 79 and 89, right? Right? So it didn't. It failed. The market was not able to take out this high here. Okay, so that, you know, again, it failed, but nonetheless, a small little loss. If you had been going long right in here, your stop is right in here. A little loss there. Markets between these moving averages here. Boy, this looks like an outside vertical bar. Took out this low marginally, took out this high marginally, closing the mid-range though. It was not bullish or bearish, pretty neutral. Now again, I do like to take these trades at times if the market is at a significant level, and it was between the 2 moving averages, right? Once it pops up through the high of that outside, your initial stop loss is below. The one thing I love about these patterns I'm showing you is your risk is very small and very defined, and your upside potential is enormous on those type of trades. So you made a new high. So let's just show you another example. Again, I got about 28 minutes before I hand it off to Doc, my partner in crime. So I don't want to go over. So I'm going to go quick here. Market, look at, made a new high. See, made a new high here, made a new high here. Nice, clean, crisp move to the downside. You get an inside pattern right here. You see this, folks? Look at this. Inside pattern. Market takes it out. I'm long right above there. My initial stop loss is right down in here. Again, profit objective definitely hit right up in here. You take 2 times that range. Okay? Now, let me give you a little variation. Remember I showed you bull traps and bear traps to the engulfing pattern? Those were just slight variations of the engulfing pattern. I mean, not really a variation because they're still engulfing patterns. They just weren't bullish or bearish. They were in the opposite direction of the trend. But again, I showed you that trade as it comes back up through that higher low. So this is a variation of the inside pattern, right? And the only variation here is what I like to call it's a tight little inside vertical bar. Whereas what I showed you just a minute ago here, see this inside pattern? See the high? The high is lower than the prior bar's high. The low is higher than the prior bar's low. It's kind of, within the range, right? Whereas what I'm showing you here, the reason it's a slight variation is it's small. It's actually, this inside pattern is actually occurring in the bottom quarter of the prior price bar's range, okay? Which is very powerful. The smaller the range, that inside pattern, usually the more powerful the move it is, okay? So And especially when you're buying the market in an established uptrend into a logical support level, okay, and it's in the bottom 50% of the prior price bars range like it is here. Once that market pops up through the high of that inside pattern, I love those trades. I'll take them all day long, okay? Again, your initial stop loss, your ISL is placed below the low of the prior price bar, and on these trades where that range is so tight, I'm, instead of looking for a 2 times profit objective of the range, I'm looking for 3 times the range of that inside pattern. So again, take the high minus the low, get that range times 3, add it to the entry. That's my first profit objective. Again, same rule applies. Once you get 70% of your profit objective, I would move my stops to break even. Make sense? So if you look over here, it's the same scenario, but on a candlestick chart. Again, just a slight variation of the normal inside pattern. That range is in the bottom quarter of the range of the prior bar. So let's take a look at an example here. Again, look at this example. Trend is up, okay, makes a high, pulls down, pretty much touches that moving average, create a tight little bar. It's in the bottom half of the prior bar, pops up through it. All your profit objectives easily hit to the downside. Makes a new high, comes, I know it failed here. It did. And it came down, penetrated down through the lower average, and you had an inside pattern again. The reason I used a dotted little oval shape here is because the market didn't take out this high, so it didn't really fit within the criteria of making new highs, but still, it was a winning trade. I showed you a losing trade on this. This happened to make money. Again, if you decide to take a trade like this, no big deal because you know your initial stop loss is below the prior bar's low. So on something like this where the market's been trading above those key averages, the 50 exponential 89, I mean, your risk is low and your upside is really unlimited. Unlimited upside with a very limited downside, okay? So hope that helps a little bit there. And then let's just reverse what I just talked about. Now we're talking about a downtrend, okay? Again, we were talking about an established uptrend, right? Market pulling down into support. Now we're just going to flip it over to the other side. Market's in a downtrend, making lower lows, lower highs. The market hits a low, bounces up off that low into a logical resistance area. You get an inside pattern, right? In a case like this, again, I don't care where it opens or closes. I could care less. All I care about is if the market's able to penetrate down through the low of that inside pattern, right? That's my trigger to actually go short. My ISL, my initial stop loss, is directly above the prior bar's high. My first profit target is 2 times the range of that tight little inside pattern, okay? That's simple. Very simple trade setup, okay? So let's take a look at a chart here. So look at the trend is down. Market's trading below the 50 and 89. Pulls up, and it takes out the moving averages by just a little bit. So look at this inside vertical bar. Okay, a very, very low risk trade. You go short as the market takes out that low and place your initial stop loss above the prior high. Now, depending on where it took, if it took out the low first and then intraday, it took out the high, you would have had a small loss in here. Okay, so makes a new low here. Now look at again, right in here, the market's not able to take out this low. So it's really up to you on whether or not you'd want to take this short trade as it takes out that the low of that inside pattern back to the averages. Again, your initial stop loss is placed directly above the high of the prior price bar, never hit it. So in this case, where the market did fail to take out that low, it was still a good trade. You can see that the profit objective is easily hit, made a new low, popped up. Look at this inside pattern right in here, took out the low, you're going short right in here, and the market makes a new low again. Make sense? Move on here. Now let's talk, we're going to flip it. We're going to use the variation of that inside pattern, right? Again, the variation is simply, it's a really tight range, and that inside pattern is in the top 50% of the prior price bars range. Market takes out that low, you're going short. Your initial stop loss, your ISL is placed directly above the prior bar's high, right? So your profit objective, instead of 2 times that range, you're going to use 3 times the range. So again, you're going to take the high minus the low of that inside pattern, times 3, get that range, and subtract it down from your entry price. Okay? Again, market hit 70% of your profit target. I would move the stops to break even, so it becomes a free trade. Okay? Again, right over here, same thing. That inside pattern occurs in the top 50%. Right? Let's look at some examples here. Again, look at trend is clearly down, hits that low, rallies up. You get the inside pattern here, takes a couple bars, but you finally penetrate down through it there. That's your short. And look at, again, 3 times the range of the inside pattern. I can tell you right now, the profit target was hit right in here before moving a little higher and dropping even further. Okay? All right, let's talk about the Bob. Call it the Bob blow-off bar. Okay? All right? Again, the blow-off bar. We're assuming that the trend is up. The market's trading above the 50 to 79 exponential moving average, right? Market pulls back into a logical support level. That's important, right? So again, it pulls back into a logical support level, i.e. the 79 to 89 exponential moving average. You don't get an inside or an engulfing, but rather you get a bar that looks like this, right? Open and close in the top. It's got to be in the top quarter of the range, open and close. So think about it. The market opens up, market sells off intraday, manages to completely reverse and close in the top quarter. That's pretty powerful. As long as that bar isn't logical support and the range of that bar is roughly, 125% the prior 3 bars range. It's got to be a little larger of a range. It means volume, volume picked up, and it looks like, again, blow off. Market kind of blows off some steam to the downside, closes higher. It looks like the market's going to move higher. So again, you can enter the market as the market penetrates up to the high of that bob, that bullish bob, or near the close, or if the market pulls back a little, you can get a little better entry. It's really up to you. But you have to keep in mind your initial stop loss goes directly below the low of that bullish bob bar. Okay, so over here on the candlestick, excuse me, open and close in the top quarter, initial stop loss goes below that bar, and your profit, your first profit target, is just 1 times the range, the same as the engulfing pattern. Okay. Now you might be asking yourself, what? You might be asking, well, profit. You have other profit objectives. You use a trailing stop. Good question. Don't have enough time to go into all of that. I just wanted to outline this. Again, I'm giving you the patterns themselves. I'm giving you the catastrophic stop loss, the ISL, and I'm giving you a very logical profit objective. Okay, and I'm giving you an area in which you would want to take your trade to break even. Right, and that's 70% of that profit target. All right. Let's look at an example here. The market's kind of chopping around. Let's see, what am I showing you here? Well, yeah, I got an inside pattern here. The market's pretty much choppy in here, but the overall trend is up. Again, I like the clean, crisp moves down into a support. This really isn't a great example. This is a better example right in here. Let's just ignore it. Look at this. The market, by penetrating up through this high, is confirming that the trend is up again, right? I mean, even though the trend is still up, it's kind of in sideways, kind of consolidating here, taking a breather before it moves higher, right? I mean, you do have an inside pattern. It takes out that high. That could have been a good trade to the upside with a stop below here. Or you could have viewed this as a bullish bob right in here, but the range of this bar isn't bigger than the prior, so that doesn't fit. But right here, NH stands for new high. When the market penetrates up through this high right in here, the trend reaffirmed itself by taking out that high, right? So the market pulls back. As you can see, right this bar is a bullish bob. Perfect example, open and close in the top quarter. Below that bar, right in between the 79 and 89. That's a great trade. As you can see, it moves to the upside there. Okay, let's just reverse this quick. So again, the trend is down. The market bounces up off of a low into a logical resistance area. We're going to be looking for a bearish blow-off bar, right? Open and close in the bottom quarter, right? Open and close in the bottom quarter. I really like to see that the range of that bar about 125% larger than the prior bar. Okay. So it's a little larger range bar, and it opens and closes in the bottom quarter. All right. That is a short. Again, you can short it as it closes or the next day's open. It's really up to you. Or if you're a little bit more conservative and you want to see follow through, you can wait for the market to actually penetrate down through the low of that bearish bob there. Again, your initial stop loss is directly above the high of the bearish blow-off bar, and your profit target, your first profit target, your first one, is the range of that bob. So high minus low divided by high minus low, get the range, subtract that down from your entry. That's your first objective. Let's look at an example here. Market comes down, penetrates down. Again, not a great example of a trend really changing from up to down, but what I'd like to see is if you get at least 3 price bars, as you see right in here, I actually had 4. If you get 3 or 4 consecutive price bars, trading completely below the lower moving average, like you do here, 1, 2, 3, 4, you could consider that as a changing trend from up to down. And if that's the case here, then you want to sell it at a pattern. And you got a bearish bob here, open and close in the bottom quarter, go short, and you can see the market continue to move lower. All right, so let's just sum these up real quick, and I'll pass the baton off to Doc. Again, let's talk about those bullish patterns, right? You've got the bullish engulfing pattern, right? Or the bullish BU, OVB, outside vertical bar, right? High and low exceeds the prior bar's high and low. It closes in the top quarter. That's your entry right there. This is your profit target, 1 times the range. Your initial stop loss is directly below the prior the low of that bar. That's the pattern. Again, the bear trap, again, the same thing as what we just talked about, but instead of getting a bullish engulfing pattern, you get a bearish engulfing pattern. As long as the market's able to take out the high of that bearish engulfing pattern within 2 price bars, 1, 2, boom. Your entry is when the market penetrates up through the high of the bearish engulfing pattern. That is a great trade. Again, it doesn't occur that often, but when it does, a very, very, very powerful move, okay? So be aware of that. Then we've got the opposite of an engulfing pattern, which is that narrow range bar, the inside pattern, okay? The high and the low are not able to penetrate through the prior bar's high and low. My actual trigger to get long is when the market penetrates up through, right, up through the high of the inside pattern. Again, I could care less where it opens or closes, could care less. My trigger rather is when the market penetrates up through that high. As soon as it's penetrated, my initial stop loss is below the prior bar's low. A lot of times if I'm swing trading this off of a daily chart, as soon as the market penetrates up through the high of that inside pattern, my stop will actually be below the low of that inside pattern. Because look, for me to get stopped out on an intraday basis, the market would have to completely reverse and take out the low, which would mean you would get an engulfing pattern on that same day. And engulfing patterns don't occur very often, anywhere from 9 to 12% of the time. So you're pretty much safe by placing that initial stop loss directly below the low of that inside pattern, as long as the high is broken first, okay? Again, first profit target is 2 times the range of that inside pattern, okay? And then the variation of that inside pattern is when you get an inside pattern that occurs in the lower 50% of the prior price bar, okay? Very powerful move. And in a case like this, my initial stop loss is directly below the low of the prior price bar. And again, my profit target is 3 times the range of that inside pattern. Again, once the market hits about 70% of my profit target, I move my stops to break even. All right, and then the last pattern we talked about, the bob, the blow-off bar, the shooting star, some people like to call it, who use candlesticks, right? Open and close in the top quarter, both open and close rather in the top quarter. So the market opens up, sells off, is able to reverse intraday, manages to close preferably above the open, but still in that top quarter. That's a great trade. Either buy it on the close or the opening of the following bar, or wait for a little pullback. What you have to understand though is that initial stop loss needs to go directly below the low of that pattern. And if you're more conservative, wait for the market to penetrate up to the high of that bullish blow-off bar. And your first objective, your profit objective, is 1 times the range of that bob. And again, a little summary here for the bearish patterns in an established downtrend, right? You got the bearish engulfing pattern, right? Closes in the bottom quarter. Market takes out the high and the low of the prior bar. I know there's a lot of repetition here, but that's what it's all about. Understanding like the back of your hand here. So again, you're shorting that market as it closes, or the opening the following day, or wait for a pullback. It really, you know, it's up to you on how you want to enter it. But once you see that bearish engulfing pattern in an established downtrend, when the market rallies up into a logical resistance area, this is a good trade. Again, that initial stop loss goes directly above the high of the bearish engulfing pattern. A little variation of that is what I like to call that bear trap again, right? So again, the trend is down. The market is pulled up off of a logical, off of that low in that downtrend, right? So instead of getting a bearish engulfing pattern, you actually get a bullish engulfing pattern. If the market is able to penetrate down through the low of that bullish engulfing pattern at this logical resistance area in the downtrend, I'm going short. I'm going short as the market penetrates down through the low of the of that bullish engulfing pattern. So I call it the bear trap, right? So that is the short trade, or I call it the bull trap. Doesn't really matter what you call it. It's a bullish engulfing pattern in a logical resistance area in an established downtrend. So as the market penetrates down through the low, that's where you go short, and your initial stop loss is placed above the high. All right, so again, the opposite of an engulfing is that inside pattern, right? And then we got the variation. We talked about this, right? So again, I could care less where it opens or closes. All I care about is if and when the market penetrates down through the low of that inside pattern. The market's contracting, so to be logical, the market's always got to expand at some point. So when it penetrates down through that low, I am going short. My initial stop loss is going directly above the prior price bar's high, and my profit objective on this is 2 times the range of that inside bar. Okay. Again, the variation is when you get an inside pattern in the top 50% of the prior price bar. Right. It's a real tight range. As the market penetrates down through the low of that inside pattern, I'm going short. My initial stop loss above the high. And my profit target is going to be 3 times that range, right? So take the high minus low, get the range, times 3, subtract it down from that entry point, and that is what you get, okay? And then the bottom, okay? The open and close in the bottom quarter of the range, going short either as the market penetrates down to the low of that bearish blow-off bar or on the close. It's really up to you on where you want to enter that, but initial stop loss is directly above that high, and your profit target, your first profit target is 1 times that range. So again, if the market hits 70% of your profit target, I'd move your stops to break even. And that's really all I have. So I appreciate it, Morgan, for inviting me to come out tonight, and I'm going to pass the baton off to Doc Severson, my partner in crime here. So I can be reached at Todd if you got any questions. I can be reached at Todd, T-O-D-D, at tradingconcepts, with an S, INC.com. You can go to the website, as you see down here, tradingconceptsinc.com. Put your email address in and get Doc and I's free videos that we put out every day. Or send me an email, or heck, give me a call. I love talking to people that want to learn how to trade as well. So, all right. I don't see a whole lot of questions. Yeah, there's a lot of people on tonight, that's for sure. See a lot of students on here as well. So great. Again, if you've got any questions, just email me, and I will certainly get back with you. But definitely go to tradingconceptsinc.com and just put your name in, and you'll get my daily video, Doc's video, and we've got others that put out some great content on a daily basis. And it'll definitely help your trading. You'll see me put on a lot of these types of trades that in the live market environment. So, okay. So I don't know how to pass the baton off to Doc, but I'm a little early, so that's good. I can go over like, I did go over 7:15. Okay, I'm sorry, Doc. I'm eight minutes over, so I'll let you get on now. Okay. How do I do this? Morgan, you there?
All right, great. Thanks, Todd. Awesome job as usual. And again, guys, you can click that link that we posted if you want to get Todd's daily videos. He and Doc send out just daily market videos on trades that they're taking. So it's kind of no nonsense, no fluff videos that I think you guys will really enjoy. I know a lot of people in here probably already get them. I know I get them every day and been very helpful. So check those out. And Doc, you can go ahead and start your desktop sharing. Looks like you've got it going. So thanks again, Todd. And Doc, we'll turn it over to you. And Doc's getting his audio set up here. Doc, click the mic icon in the bottom left. Give us just 1 second here. Doc, it might help if you want to try logging out and logging back in. Maybe try coming in under Internet Explorer. Sometimes that can be an issue. And somebody asked for the schedule of speakers. There you go. Just type that in.
Okay, I think we have audio now. How's
Doc,
that, guys?
you're good to go.
Okay, awesome. All right, guys, let's see. I've got just a few minutes left, and I believe I can keep everybody on time here. Sorry for the technical issues here. Looks like I had a little cookie issue. All right. My name is Doc Severson, and what we're going to go over today is just a little bit of extra information on top of what Todd talked about. Now, I don't have a whole lot of time, and I want to keep you guys on time for Hubert. So I'm going to add just a little bit of extra information about price action. But first, before I do that, who am I? Who's this Doc guy? I am the Chief Options Mentor for Trading Concepts. I produced a daily market newsletter since 2005, so I've been through the wars. I've mentored thousands of students during this time. I am a husband and father of 3, and my passion is to cycle for charity to raise funds for cancer research. That's what I do. I'm also a poster child for Rogaine on the side. So what do I believe in? What do I believe in when it comes to the markets? I believe that this is no longer your father's stock market. Things have changed if you guys haven't noticed. Yet I strongly believe in the power and opportunities that a free market will continue to provide. So I think this is one of the most important steps that a trader can make. You got to turn off the news and focus on the charts only. I've heard some great stories about your next presenter coming up about how he's able to do that as well too. But you have to put in the years before you'll trust yourself to go against the herd. That's what you got to do. What else do I believe in? I believe in consistency and performance and not home run trades. I'm not one of these guys that's knocking the ball out of the park and swinging and missing and stuff like that. I believe in consistency and trying to every day push the stone a little further up the hill. So I believe in trading with an edge in my favor before I will risk my capital. So I also believe in risk management. If you trade options especially, you have to understand risk management. It's not what you collect, it's what you keep that counts over time. Okay, so now that you guys know where I'm coming from, let's shift over to the WIFM, which means what's in it for me. Why should you guys listen to me for the next 20 minutes here? What am I here to talk about? Well, we all start in the same manner. We start with stocks and we learn the same old technical analysis techniques, right? Oscillators and MACDs and things like that. And it looks pretty easy in the seminars that we attend. But it's really hard to duplicate in today's market. It is really different this time. So today's market is not, I mean, what used to be a rumor in 2005 is now true. I remember all these rumors about what they called the plunge protection team. I don't know if you guys remember that, but that was a big rumor back then. And now it's absolutely true. We're printing dollars out of thin air. We're goosing the economy, and all this money has to find a home. And guess where it's finding it lately? Well, with interest rates near 0%, it's not sitting in money markets. So the standard tools and techniques are just different these days. What was a fairly quiet bull market from 2003 to 2007 is far different from today's cyclical bull that started in 2009. We have much greater velocity in both directions with this bull versus the last one. And we will no doubt have the same thing happen when the bear comes. And guess what? It will come, guys. So how does this make trading harder for investors using the standard tools and techniques? Well, if you look at the market that we had not long ago, 2005, 2006, it was very choppy, slow-moving price action. This worked great with things like oscillators, MACD divergences, all the standard tools that we learned in the workshops once upon a time. But in today's volatility, we get these trends that go for miles without significant pullbacks. And then they reverse and they do the same thing again. It's a different market because of this. So if we use our standard tools, an oscillator like stochastics is just going to get swamped. It's going to produce useless signals, especially at the top. We see these overbought, 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 literally for months at a time. It's useless, okay? And even things like MACD histograms, which Alexander Elder once called the strongest signal in technical analysis maybe 10 years ago, also become useless because you see divergence after divergence and crossover after crossover. It just doesn't matter anymore. So investors are either on the sideline waiting for something to happen, or they're being chopped up to death by these unusable signals. Now we can use the standard tools like what I talked about, the histogram divergences and the MACD or the oscillator crossovers. And these divergences used to be what we would add on top of them. Well, no longer. These are not producing usable signals either. The reversals eventually happen only after multiple false positives. We've all been there before, right? I mean, we've seen this over the last 4 years again and again and again, and it gets to be, you wonder, okay, is the market out to get me? So what do you do about this? Well, the standard tools that work so well during the choppy years don't work so well in today's QE market. So we can go through our list of 200 indicators and find that holy grail one, right? Oh, all we need to do is get the pitchfork on there. and things like that. And we can back test it. We can see which one curve fits the best, okay? Or we can apply price action and new thinking. Now, price action is basically what Todd just went through with you for the last 45 minutes. The thing to keep in mind is that indicators are based on price and volume. So they're inherently lagging. Right off the bat, they're going to give you lagging signals. And this is why Todd and I believe in the benefits of price action. Price action alone will never lie to you, but it does require that you learn to read it. So what's the problem here? Well, one of the biggest problems that I see traders run into is following the signals, but they're too late to the party. Many times this is because they want to wait and confirm the trend first so that everything feels good for pullback entry. Unfortunately, many of you out there are trading not to lose instead of trading to win. You're waiting until things feel good, and usually by that time, it's way too late, guys. So in today's market, that's way too late. All right, so let's look at this. We have a daily chart of the S&P here going back to May. So here we see these pullbacks. We see pullbacks again and again and again, all the way down here. And finally, you know, this trader has missed every single one of these pullbacks trying to go long. And so what he's saying is, all right, the next one that happens, I'm going to jump on this sucker. So I'm waiting to jump on this train. Okay, so here's a good pullback. Let's go long. This one finally feels good. We've even got a little hammer. This may even be a signal that Todd just went over. Okay, but I enter and it just keeps on going lower. I mean, that's all happened to us, right? We wait until everything feels perfect and all of a sudden we get run over like a train. It keeps on going lower. So what happened? What hammer time? I love it. Yeah. What happened here? Did anything happen? I mean, or the market just out to get me? Well, you did everything right according to the book, yet you still got run over. So this is where many retail traders start to feel as if the market has it in for them. And this is actually a dangerous thing. You start to joke around with your friends and say, if I go long, then you guys should go short. I mean, we've all that's sort of a rite of passage that we go through. We sort of joke about it, but in the end, it hurts when you have to say something like that. But there's some very real reasons why you did lose that trade. Okay, it was a weekly chart pullback on the weekly chart. So I've got the weekly chart up now, and all you ran into was just a typical weekly chart pullback. So how could you have known? How could you have known? How could you have done something? What could you have done to stay out of that? Have you ever noticed that we do our best to come up with ideas on our own, but we tend to over-engineer the solution? Sometimes we can't see the forest for all the trees that we're in. We keep pushing that stone up the hill, and we don't bother to look up and look around and say, oh, what am I doing here? What's going on? Why doesn't this work? Why don't my tools work? And other people are making money in the market. So we end up with something that works, but not all the time, and then we don't know why it fails when it does fail, just like that pullback. So sometimes the best answers that we have out there are found in nature. Let's give an example for the birds here. We've come a long way in a very short period of time with our aviation designs. But our aircraft wings are still inefficient, or at least they used to be. And we were seeing a vortex of air spilling off the wings of our aircraft, reducing lift and creating more drag. But we saw that birds had already solved this problem a long time ago with their wingtips. You notice how the edges of the wing flay out like this, okay? And so what somebody did was, somebody said, you know, maybe we could do the same thing to planes. And that's what we did. We added winglets to them. They stole the idea from nature and they added winglets. And planes can now fly further on less fuel. I think they did this around maybe 20 years ago. So what is there about markets that we can learn from nature? Well, this is where we get into fractals. You may have heard this term before. And it's something that it's not something you're going to learn overnight, but it's something I want to expose this to you if you haven't been exposed to this. Think about a tree like this. A tree is not a single entity by itself. It's not just, well, there's a tree. It's composed of many different parts to it, right? You've got the trunk, which leads to the limbs, which leads to branches, and eventually to the leaves at the very end. So each branch is a miniature version of the entire tree. Notice how this branch out here is a miniature version of the entire tree. Yes? So in effect, this big thing is made up of many small things that add up to form the entire entity. And if we look around us, we see the same thing everywhere in nature. And I've got people that are putting in some examples in the chat room, and I think that's great. Everywhere we look around us, we see the same thing. I mean, each of our bodies is made out of cells. You know, we see a person there, but it's just a collection of cells. So these are fractal relationships. That's what this means. And markets are fractal. Guess what? Markets exhibit the same structure as common items that we find in nature. So larger time frame market moves are made up of many smaller time frame moves. I mean, I know that that's an obvious statement, but sometimes we don't stick our head up to look around and say, oh, well, yeah, well, that's, everybody knows that, but yeah, but not everybody is applying that. The larger time frame movement overrides the smaller time frame movement, much like the tide overrides the individual waves of the ocean. Or you could also say, like how the ocean current overrides the tides. Yes? So how are the time frames related? So should we just pick any old time frames on here? Let's pick a 240-minute chart and let's tie that in with a 5-minute chart. Is it just arbitrary, or is there some kind of relationship here? So how can we use groupings of these time frames together? Well, what I found, and I just want to, without going into the theory or anything like that tonight, we'll just throw it out there. We've got what's called a factor of 5. We found that the factor of 5 works very nicely to separate time frames. And you've probably already been using this to some degree without even understanding it, which is fine. This factor of 5 works out very nicely. These are known as fractal relationships, where the larger structures are built from many smaller ones. So we can use this relationship between time frames to better understand what's happening under the hood. So trend reversals begin from the inside out. So if we have a small little time frame down there in the green in the lower left that starts to reverse, then that smaller intraday time frame will start the move, and it will start to propagate to the next fractal time frame in the yellow, which is maybe the daily time frame here. And then that's going to propagate to the blue, which is the weekly time frame, and then eventually that will propagate out to the monthly chart in the red. So this is how things move. I mean, you can also think of this as like if you get a virus, you start out with one virus attacks a cell, and then that begins to multiply. And then next thing you know, a day later, you know, you feel like you've been hit by a truck, but it all started with one virus doing that. So you can think of this as kind of a family of time frames. I'm really big on analogies, and this is the way I want you to kind of remember this, is that this factor of 5 series of time frames, monthly, weekly, daily, and intraday, that's the ones that we're going to use, acts like a family of 4. The parent time frames, you can think of the parent time frames as the monthly and the weekly, do not change direction very often and tend to keep going in the same direction for a long period of time before they reverse, especially in this case, the monthly chart. Okay? But the child time frames can actually slow things down and cause problems. You know, how many times have you guys been on a long family vacation with some very young children, and even though you know that you're going somewhere and the parents will get to their destination, if you've got a 2-year-old that refuses to move, it's going to slow you down, right? Conversely, if you've got a 2-year-old that's ready to go, but the parents are exhausted, that market's going nowhere, right? Those of you that have children know what I'm talking about. So here's an example here. Let's look at a weekly chart, right? So this is just a weekly chart here, and here's the trend, and we have a nice uptrend. But within that uptrend, it doesn't seem to carry much information in that. You always see is just a bunch of candles heading higher. But within that trend, you've got the fractal daily chart. And we see a ton of information in there. We see an impulsive move to the upside, we see a retracement, we see another move, we see retracement, we see a move and a retracement, and finally a finishing move before we see a deeper retracement. So this is the moves within the moves that I want you to start looking for. Okay? So we have to watch for these swings within the larger swing to understand how markets move. And each time frame will have a superior and a subordinate time frame that's associated with it. Now there's two natural rules. If there's two things that I want you to remember as I walk away from this in the last 10 minutes here. So if you remember nothing else, it's these two things I'm going to bring up in the next slide or two here. Number one, larger time frames exert more influence on the overall trend. When in doubt, understand what the larger time frame's trend is. Many times we get too focused on one single time frame and we forget what's happening above it, right? Maybe we get focused on a daily chart. Maybe if you're an intraday trader, maybe somebody like a day trader like Todd is going to look at a 3-minute chart, but they've forgotten what's happening at a larger time frame. That larger time frame is going to have more influence on it. So when in doubt, understand what the larger time frame, that anchor chart, is doing. Rule number 2, reversals start from the inside out. A trend reversal starts from the very smallest time frames and starts to propagate. Think about an avalanche. An avalanche starts at the top of a mountain from one single snowflake banging into another one. And then that chain reaction, those two snowflakes bang into 4 of them, and then 8, and then 16, and then the whole thing starts to really move, right? Reversals start from the inside out. Now, this may seem like it doesn't make sense based on rule number 1, but it's true. Reversals always start from the inside out, so think of it that way. So how can you apply this? I have to admit that this is taking me several years of staring at a chart every day for this to become second nature. This is not something you just pick up overnight, but I do want to plant the seed with you guys tonight before I leave. So at first it's very confusing to watch 4 times the number of charts, right? It can be very confusing because all of a sudden you lose track. You know, do I follow the larger anchor chart, or do I focus on my main time frame chart? What do I do? But it's a beautiful thing when you understand how this puzzle fits together. When you understand how all of these 4 time frames fit together, then all of a sudden the market becomes less arbitrary to you. It becomes much more clear. You're much more in tune with what it actually wants. And you can supply the correct trades to be able to give it what it wants. So at first, if you want to apply this, at first just watch 2 time frames. Don't go to 4. Don't overwhelm yourself. Just start with 2 time frames. If you're a swing trader, watch the daily chart and add the weekly chart to that. If you're a day trader like Todd, if you're doing a 3-minute chart, watch that and the 15-minute chart. It was interesting because as Todd was going through some of his examples, some of the stops that he took were because of that 15-minute chart was just making a pullback, right? That's the way you apply this. So understand how the smaller time frame charts fit into the swings of the larger time frame chart. So an application of this, if you want to know how to apply it, if you're a non-directional options trader like myself that does iron condors, things like that, you can better estimate when a trend is about to give up the ghost and reverse, and I can set up credit spreads in that direction with a high probability. I can fade that move more accurately. Or if you're a directional swing trader or a scalp trader, you'll be able to better estimate when a new swing will begin, and you'll be able to discern a normal pullback from one that's occurring at a larger time frame chart. So if I look at today's fractal charts, I took this morning, so it's pretty much accurate here. We obviously, with the monthly chart, we have a parabolic uptrend, just a screaming uptrend, right? So within that, we have the weekly chart, which has also gone from a screaming uptrend, but it's still making higher highs and higher lows. We don't see any kind of reversal happening on the monthly or the weekly charts yet. But this is the fly in the ointment. Now we have the daily chart, putting in a lower low, and could be potentially getting set up to put in a lower high. Reversals start from the inside out. Remember, they start from the lower time frames. And if I go to the 78-minute chart, the 78-minute chart, at least as of this morning, was in a confirmed downtrend with a series of lower highs and lower lows. But it will show us when it starts to make higher highs and higher lows and change that polarity into an uptrend, which is just going to be a pullback on this daily chart. So this is how you have to kind of do these things, is you start from the top, you do a top-down analysis, and you see where things are going. And you don't see a whole lot of movement, you don't see a whole lot of change in the monthly and the weekly. And you do see a lot of change in the 78-minute, certainly. And why 78-minute? Well, because it's 5 times faster than the daily chart. So it's not just an arbitrary time frame there. So in summary, and I'll be able to get you guys on time here and give you a little break. We can use the fractal relationships and that factor of 5 to determine the time frames that we're going to monitor. And we can also look for the larger time frames to dictate the direction, and the shorter time frames to show us an early warning on reversals and or perhaps an entry, a higher probability entry if we're trading off of the anchor chart. So the next steps that I want to see you guys do, you can combine these things, these fractal time frames, with a tool like such as the ADX, right? So it's the old Wells Wilder, to determine when a trend has reached its target. Like, for example, like if I'm watching the ADX 13, like Alexander Elder, I know that when a trend on the daily chart gets up to maybe in the 40s, that thing is toast. It's not going to go that much further. The probabilities really disfavor any further movement on something like that. And it's just because I've watched trends before, right? So you can combine this with a tool. And I personally watch the linearity of each time frame through what's called a choppiness index. It's kind of an obscure indicator that I found, which gives an accurate probability that a time frame is tired and ready to stall. So I can use the price action of these fractal time frames in conjunction with something that tells me the strength and or the weakness of that move. Okay, Todd mentioned this before, but we want you guys to follow us for free if you go to the Trading Concepts website. If you go to this place called a blog over here on the left-hand side, the arrow is pointing to the blog. If you go into there, you'll see our videos, and if you want them to be emailed to you, you can just enter your name into there. So I talk about option topics, swing trades, risk management. I do talk about the fractal energy theory that we showed you today quite often. Todd's usually posting things about Forex trades, E-mini trades, and also stock directional trades. So Todd's kind of the directional guy, I'm kind of the non-directional guy. But we both focus on price action. So go to one of our posts and enter your email into the box, and you'll be copied on our daily post in your email. Okay, I have 2 minutes for questions if anybody has anything. I appreciate Morgan inviting us today, and thank you guys for your patience. So Ken is asking if you have, or if you use a 1 hour chart.
Really appreciate it.
Would you need to do a 4 hour chart or 5 hour chart? Yeah, so a 5 hour chart would be your anchor chart on that one as well. Greg is asking if this has anything to do with Elliott Wave, and it certainly does. There are elements of Elliott Wave in here. If you read the Prechter books, they talk about these same kind of things. I think what's different here is we use the factor of 5. I think that's the difference here. Well, this has nothing to do with fibs, but you can certainly incorporate fibs into this as well too. Okay, I'm going to turn it back over to Morgan. Morgan, again, thank you very much for including us on this insane-a-thon for 24 hours, and I look forward to hearing from you guys soon.
Appreciate you guys being here for sure. And we're just now approaching the halfway point, and I think that it's been excellent so far. Hopefully the second half will be as good as the first half. And Doc, Todd, thanks again for taking the time. Both of you guys tag teaming that and coming on and just sharing some really good information. I hope that you guys will sign up for their newsletter. It's a free newsletter, and the subject you'll get in your inbox comes in typically around 4 o'clock each day. It says actionable trade alerts, basically where they'll go through about a 3 or 4 minute analysis of what they're looking at in the market. So thanks again, guys. I'll post that link one more time, or you can go to their main site, just the homepage, which is tradingconceptsinc.com, and sign up for the videos. So we've got that posted as an announcement. One last thing I wanted to do, we had several sponsors for this event, and I'd like to thank one of our sponsors that has actually been streaming this event live on their site, which is financialjuice.com, which is a new news site that provides breaking news in the markets, in all different markets, and user-generated news. So you guys definitely check it out. If you're enjoying this event, be sure to go to their site, let them know that you appreciate them being a sponsor of today's event, and helping to spread the education. Like I said, they're streaming it live from their site as well. So we've got over 800 people here in the room, and then another probably couple hundred people watching it there. So have a great crowd. And it's now almost 8 o'clock Eastern time. Here's a quick look. You guys should see a